Hello, welcome. This is Bert Dohmen with Making Money. Thank you for joining us today. Today we're going to look at some of the factors which may help you to increase your profits and reduce your losses. Let's take a look at the characteristic of the market in general and then what effect it has today. The first chart will be of the SONETTE bubble, and this is a matter of physics. Here we can see the stock market index from January of 2010, and we can see here that the oscillations get smaller and smaller as the market rises. This is what typically happens, like when you spin a coin on a tabletop, and the oscillations get more and more frequent until the coin finally stops spinning and slams down. And it's the same thing in the stock market and other things in nature. And here we can see the oscillations getting smaller and smaller as the parabolic rise goes to its apex. And this is about where we are right now. So this is the time to start using extreme caution in the market. Let's take a look at the stock market over the last year and a half. Here we see the Dow Jones Industrials rising very nicely. And here the black line is the ETF for the Russell 2000. These are the small cap stocks. There are 2,000 of them, and they start at the same point, but as the market advance progresses, the small cap stocks were outperforming the big caps until we got into middle of March. And you can see the videos that we posted in middle of March on YouTube of how we identified this top. And that led to a very strong correction in the index, and a much stronger correction in many of the popular stocks. The index here was down about 10%, but the individual stocks were down from 20 to even 69%. I'll show you a table of that a little bit later. So this is when the spread between these two indexes, and in all historical relationships in the markets, when the spread gets unnaturally wide, there's always a reversion to the mean. That means it goes back to, or tries to get back to, normal relationships, and that's what we saw. And our technical indicators can identify that very nicely. So that's what happened, and since that time, the small cap stocks have been weaker than the big caps, which is a warning signal. Here we can see the popular stocks and how they declined during that weakness this year. And you can see here some of the stocks here, 69% or 68.6%, 58% for Twitter, Splunk 57%, Yelp 51% down, etc., etc. You can see here the big declines that the stock saw. So when you see analysts in the media saying that the market may have only a 5 or 10% decline, individual stocks suffer much more. Now we're going to look at the Smart Trader top 20 trades. These are the top 20 trades we've had for from December to May of the year, and you can see here some of the gains that we had during that time. These are not annualized, they're actual gains, and here the holding periods. The first one here is, of course, something that we don't have all the time. A 63% gain in just 2 days. So don't expect that. That's a very rare event. But here, JCPenney's, we were short, and it took 46 days to get 36% gain. And some of these other stocks, here's a nice one. 20% in 4 days, 16% in 4 days, etc. Here you have one 13% 3 days. So this is the kind of things that we do in our short-term Smart Trader service, which is released just about every day. And now let's talk about. Well, here's actually a chart. Let me show this. This is a chart of the same table, so this is visually probably nicer to look at. But let's look at seasonalities and avoiding the big drops and participating in the big rises in the market. You can only do that using technical analysis. You cannot do that using fundamentals. And here we see a chart of the S&P 500 ETF over the last 20 years. And look at this. The green line here is the buy and hold. If you would have bought for $100,000 the S&P 500 20 years ago, you would have made this amount of money. That means that 100,000 would have grown to about $340,000. That's not a bad gain, but 20 years is a long time. But let's say if you would have just avoided the 10 worst days in the market, only 10 days in 20 years, then your gain would have been, instead of 340,000, here at the peak, it would have been 800,000. Not the gain, I'm sorry, the rise in value from 100,000 to 800,000, just avoiding 10 days. Now, using technical analysis, you may not catch the first day of the decline, but you can catch the majority of the decline, and that's what we've done over the last 37 years. Now, of course, money managers will tell you, well, you have to be in the market at all times, because if you're out of the market, you might miss some of those days. Well, but what if you don't miss some of the big decliners and you're in there? So here is if you would have been in the market during the 10 worst days in the market, and that's a pretty stiff decline. So here we can see that market timing is really necessary. If we look at a longer period from 1950, using the Dow Jones Industrials, and invested $10,000. Seasonalities are important. You've probably heard that from May 1st to October 31st is the worst time in the market. And investing $10,000 in 1950, you would have lost money during those 63 years. You would have lost money. Okay, if you had only been invested during the good time, which is November 1st to April 30th, your $10,000 would have grown into $880,000. Wow, that is a huge difference. Now, here you can see that you're only exposed to the market risk 50% of the time. That is very important, because when you're looking at the gains, you always want to look at risk adjusted. So obviously, if you're in the market only half the time, you have much lower risk. So this is a fantastic gain. It really tells you that you should not be in the market from May to October 31st. Now, if you had been just in a buy and hold during the entire period, you would have made $726,000 without dividends. So this is something very important to keep in mind. Here's a chart that depicts the same thing, and you can see here, the November to April period in a market, and then the bad period, the May to October, which is often called the dead zone. And here's a chart of the dead zone, and this is in terms of annualized returns, plus 8.6% annualized return in a good time. And if you had invested only in May and October, you would have had a loss of 7.4%. Painful if that happens year after year since 1950. Here's an interesting chart. It just shows that Wall Street does have a sense of humor, and not only that, there are signals that are sent. Okay, and here you can see the bear market low of 1982. This was a severe bear market from 1980 to 82. Remember, in 1980, the prime rate hit 21.5%. Inflation was double digit. Paul Volcker came in. He tightened money severely. And it was a 2-year, very painful period and a big recession. But the low on the Dow Jones Industrials was 777. Wow, that sure was a lucky number. From there, it was a big bull market for a number of years. October 9th, 2002, bear market low. That was, again, from 2000 to 2002, was a big bear market. And the S&P 500 made a low of 777. You think that's a coincidence? All right, here's another one. March 6, 2009, the 2008 to 2009 market crash was very, very painful. We predicted it right to the button. On September 4th, we recommended, on September 4th, 2008, we recommended a number of the inverse ETFs, and they soared an average of 72% over the next 6 weeks. So that was fantastic for our subscribers. But look at the low. This was on that day we said close out all short positions on March 6, 2009, the exact low of that bear market. And look at what that low was on the S&P 500. It was 666, the mark of the beast. You see, they do send signals in the marketplace. Let's take a look at the buy and hold forever approach, which is so often preached by Wall Street. And actually, it's not that very productive. Look at here, and this is the from 1995, when we gave a buy signal on the market, and it had a beautiful up move to March 10th, 2000. March 10th, the exact high of the NASDAQ in the year 2000, we gave a sell signal. They said we're going into a crash, because when the Federal Reserve assumes this type of policy, it always ends in a crash. And we did have that crash. And here at the bottom in October 2002, we gave a buy signal. I think we're off here by a few weeks, and that was kind of disappointing, because we like to catch turning points within a few days. Then if you had been out of this, you would have been able to save your profits. You would have been out of the market here, and then you would have reinvested those profits on the way up here. So that's you would not have experienced this pain and uncertainty. October 15th, 2007, in the Wellington letter, it said market top. The actual top in the market was on October 11th. That was before the weekend. And so we caught that one very nicely. And then, of course, we had that market crash and the global crisis here. Here was our March 6, 2009 buy signal. We closed out all shorts. A few days later, we said this market rise will be stronger and last longer than even the bulls expect. And that's the market rise that we got here. And I have to say that this has definitely been much, much stronger than I ever expected. But, it just shows you what $4 trillion of artificial money creation by the Federal Reserve can do in the markets. Oh, here's just a chart of that market crash in 2008 that I talked about. During that crash, these 6 weeks, here were the gains that we had. One was 93% up, 85%, 74%. These were all the inverse ETFs. And this is what the S&P 500 did during that time, was down 32%. So here are the gains that we had, and that's what you can do when you're a subscriber to our services. Here's a chart that depicts some of our market calls in 2007 to 2010. Here you can see the October 2007 market top, and here sell short. Here's the September 4th, where we said crash ahead, sell short. That was right here, and then Lehman Brothers went bankrupt, and that culminated in this low here on March 6th. So this is what you can do with technical analysis. You cannot do that with fundamental analysis. All right. I want to thank you very much for being with us today, and stay tuned. We're going to come back and do this on a regular basis. We'll have some making money segments. Thank you very much for joining us today.